to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
Thank you, Intro Man. If you ever need anyone to come through, it's Intro Man every time. It's just like a rock, like the most consistent member of this channel, like by far. So thank you, Intro Man, as always. Let's get started. Sorry for missing last week, guys. Good to see you again. It's been a busy week in the Duffley portfolio, but
doing deals.
Yeah, doing deals. So happy to talk somewhat about that. We'll be talking about Carvana as well. I know our old friend, and getting into that. And also we thought we could talk about a little bit more about some Charlie Munger wisdom. There's always a good time for Charlie Munger wisdom. Before we do that, as always, check out the stuff in the description below. We've got our Discord down there and the discount links to Seeking Alpha and to Share Site. So go ahead and check those out. If you use those links, you can first off sign up for the free versions if you do. But if you do end up getting a paid version, we could get a small commission. So that would help the channel out. And ideally, you get a nice product out of it. So go ahead and check those out. And like, comment, subscribe, of course. Anyways, guys, what happened last week? We were doing a best ideas stream. I did not get to tune in. What were the best ideas that I missed? Give me a recap.
Yeah, it was a good example of why we need Jack to host the show.
Oh dear.
So that was what did we have? We had I talked about coal. Karan talked about one of the Liberty like telecom companies. What else did we have?
Yeah, we're a contrarian show. We're talking about coal and telecom. All right, keep going.
I did Alico, which is like an asset play orange grower.
That's right.
Right.
I talked a little bit about liquefied natural gas, but I was kind of all over the place. So
it's a little bit of an energy theme, it seems. All right.
There was some energy. Yeah.
It was a deep value theme, at least, I think. They're all
naturally.
Yeah.
That's the idea. at least I think so.
Yeah, we all pitched our best value trap.
That's the case every week. And then the 1 in 100 that isn't the value trap, that's the big winner. And then we claim it's like whatever, the sky is falling, boy who cried wolf, whatever you want to call it. It's something like that every week here. We're not making specific recommendations to anyone, of course. So no one would be foolish enough to follow our thoughts. So yeah, what are you going to do? Tom, I know you definitely wanted to talk about the Carvana situation, since Rob Vinall put out a letter recently, and he's the namesake of this episode. So why don't we just get into that, give the people what they might be expecting, and we can go from there.
Yeah, sure. It's really interesting. Like, Rob Vinall's an investor I've been following for a couple of years. I think, Frank, you might have pointed me his direction initially from memory. He's got a pretty good track record, but had a really rough 2022. If I pull up the numbers,
if you share your screen, I can do it.
Yeah, so the fund was down 47.6% in 2022.
That's
a very rough. Yeah, very rough year. Some of that was driven by Carvana, which he's written about a couple of times, and he did sort of a post-mortem of that investment in his recent letter. So, yeah, it's a good example of kind of some learnings from that, which we can maybe go through shortly. Overall, he still has quite a good track record. Just a little bit further down, it's got annualized return 12.4% versus 8.2% annualized for the Dow. And I should say it was good to actually see a letter come out from Rob Vinall, because he had a pretty serious health scare in 2022. Had like a stomach tumor removed, which I imagine was a pretty scary experience. And he actually wrote about that in the letter a little bit too. But yeah, I don't know where you guys want to start with Carvana. Stock's down 98% or something in the past year.
Probably.
Yeah.
Let's take a look real
Yeah.
quick.
Yeah, I think from the start of 2022 to the end, it was down 98%. I don't know what it's done this year.
96 over the last 52 weeks. Year to
There was a
date.
weird jump.
Year to
up,
date, it's up.
40%.
Oh,
Yeah.
okay. We're in a new year. Never mind. It's only
Yeah.
been 2 weeks. 2 weeks, it's up
Hit a date
almost
button.
50%, which is pretty wild.
Yeah. I mean, I don't have a particularly strong view on the stock. It clearly hasn't worked that well recently, but I think it's a good example of an investor, learning from errors, basically. With
What do you think the error was?
Yeah, we can go through a few of them. So,
A few errors.
Yeah,
Well,
he talked
a
about
laundry
three lessons from Carvana.
essentially, yeah. Have you got the letter there at all, Jack, or not?
I don't have the letter up. Can you share the letter? I just have the stat sheet. And I will say one caveat: it ain't over till it's over, and who knows?
Yeah, yeah.
But as of now, we can kind of reflect.
And I guess just a bit more context on Rob Vinall. I think, correct me if I'm wrong, Tom, you might know better than me. He had about a 15-year track record of 19 or 20% leading up to this year. So that was kind of why he had so much attention around him. It was a really great track record of outperformance. And still probably slightly outperforming S&P now, even after having the portfolio cut in half. So still an interesting investor, even though he's openly made a pretty big mistake with a few names in the portfolio.
Yeah, and he's he still lays out his overall investment strategy towards the end of the letter, which put very simply is, I think, something along the lines of buy really good businesses at cheap prices. So those are the types of investors we tend to follow, obviously. But yeah, a few things kind of went wrong with Carvana. I think the thing that jumped out to me in this letter was that part of it was kind of execution risk, probably in the company that Rob Vinall, that risk materialized, or maybe he didn't quite appreciate the execution risk that was in there quite as much as he should have. The other thing that was a red flag that probably could have been picked up going in was just the amount of leverage the company had, combined with a negative cash flow situation, combined with really, really fast growth that was going to require even more capital. So
Combined with.
Yeah, it's a bit of a
Russian dolls, right?
fuel on the fire.
Yeah,
exactly.
right.
Yeah,
A cascading effect.
Exactly. So he kind of lays out the initial bull and bear case here. You probably don't need to go through this too much, but
No.
basically the bull case was large untapped opportunity to sell cars online, superior customer experience compared to offline, and potential competitive advantages to the dominant online player. Clearly hasn't worked particularly well so far, but
keyword on potential.
Yeah, exactly. I've got two versions of this letter open, one with my notes on it and one that you're seeing on the screen. So I'm jumping back and forth a bit here. But here's a good one. So I've lost it. I'm actually just going to share my screen with the notes because I don't care if you guys see my highlights and random notes I wrote up for a video.
And if you guys in the chat have read the letter or listened to it, let us know what you thought.
Here we go.
You
Here's
got
Tom's
that one.
highlights. This probably be better anyways.
Yeah,
Use them a bit
yellow.
better. Yeah,
Yellows I was paying attention to. Red I was going to make sure I said.
Right.
So yeah. So big lesson out of this one for Rob Vinall. Approach astronomical growth rates with a healthy dose of skepticism. Growth at acceptable returns on capital is fundamentally a good thing, but it's also a risk, places enormous strain on an organization. He kind of concludes, ultimately scaling a logistics network, a lending business, a sales organization, and multiple inspection and refurbishment centers all in parallel likely prove to be too big a challenge for Carvana. So that's kind of the execution. Yeah, that's the execution side of things. He sort of talks a little bit in here about how, in hindsight, you could say it would have made a lot of sense to try and dominate some smaller market in one state or a couple of states initially and then grow out. But at the same time, I think there were concerns that an Amazon or something might see the opportunity and kind of steal it out from under Carvana before they could scale. So it was a bit of a balancing act that he basically thinks they got wrong.
He still holds like the full position, right? Or has he trimmed?
We'll tell when the next in the next 13F that'll come out, which will be, I think, at the holdings as of the end of December. We should still see Carvana in there because it was in the fact sheet that came out alongside this letter as, I think, the number 2 holding still. But yeah,
and he did double down throughout the year. I think the stock was down at about 80% at the time that he doubled down. So
I think maybe twice he doubled down.
Yeah. So as much as I do like that he's open about this mistake now, I think he was slow to realize, and he really did dig the hole a little bit deeper.
Yeah. So I don't know. It'll be interesting to see what he does over the next couple of quarters. But as far as I can tell,
as of December 30, that like kind of metric sheet, I think that was the date of the letter too, right? It said top 10 holdings. Number 2 was Carvana.
It's not in order though.
I guess it's not in order anyway, but it still was a top 10 holdings. So it's probably close to, if not the same, as what it was before.
Maybe he only has 10 holdings. I'm not sure.
This is also true. I thought of that, but he still owned it as of December 30, we'll say. So not a full sell is what we can say, or at least unless he sold in the last 2 weeks. I just find it interesting. He's talking about like post-mortem, what I learned, yada yada, but still holds. So that kind of adds a wrinkle to it.
Yeah, I actually didn't realize that wasn't in size order. So I think I said before it was the second biggest position, but that might not be correct. So, that's the other thing he said about kind of doing a lot of things at once. So, my sense is the company was simply being too aggressive. It went hell for leather in virtually every aspect of the business. And he's got a good comparison to CarMax here. Most apparent in the financial structure, too much debt, but it's also apparent in its operations. It tried to carry almost every type of car in inventory. It extended its logistics network to nearly every corner of the US, and it provided financing for nearly every type of customer. As a counterpoint, CarMax, in over 30 years of operations, still only provides financing to prime customers, blah, blah, blah. A more cautious approach would have been to start with a narrow range of inventory markets and customers, and having profitably scaled in one niche, gradually expand outwards. So,
Julius Caesar in the chat says Rob Vinall's average price paid for Carvana was $148 a share. That's an ouch. Near total loss.
Yeah. Is that? I don't know. I'd be skeptical on that because if that's just coming from one of the whale wisdom sites or something,
it's probably
like the share price it's moving so rapidly. Who knows?
Well, whatever. It went from a lot more to a lot less.
For sure. Yeah, it talks a little bit about can Carvana-esque mistakes be avoided in the future. This is a big learning for him, I think. It was wholly inappropriate for a company that was loss-making and had huge capital outlays ahead of it to be carrying any debt. Carvana should have had net cash, and classic Buffett quote here, because apparently he says it best. Almost anything can happen in financial markets. The only way smart people can get clobbered really is through leverage. It's the one thing that can prevent you from playing out your hand. All the hands we enter look pretty good, but you have to be able to play them out.
That leverage quote, or just that sentiment, you see it everywhere. That always gets to me as someone with quite a bit of debt relative to net worth.
You gonna be able to play out your hand, Jack?
So I'm trying. Well, hey, this month, I've made it a goal. I'd said to pay off $200,000 in debt over the next year, or for 2023. And this month, I'm already up to almost $18,000 in principal pay down. So, we're off to a good start.
Nice.
So trying to get some room. Cause that's how it would all crumble at this point. It would be some sort of cash flow crisis for a long enough time. And you still got all those debts to pay. So trying to get some room.
Yeah. I really like this point here too, Tom. You've gotten right.
You go for it, Brad.
So I didn't know this, but when the fund was started, Rob had I think all 10 of his holdings were German small caps. And now he has one German small cap. So it's fascinating, at least for me, to see how fund managers evolve over time as the AUM increases. And he talks about how, each investment he's made has, taught him something, and he's doubled down on what has worked and moved away from what hasn't worked. So we can anticipate that he'll be moving away from companies like Carvana in the future.
Yeah. So at a high level, it doesn't change this bit. Try to buy great businesses run by honest and talented managers at a cheap price. But yeah, like Brad's saying, at a micro individual company level.
Also the honest individual
You'd have a lot of people arguing with him about that with Carvana, but
yeah, there's a good conspiracy theory that Carvana is a front for the loan company that they own. It's a good conspiracy theory. It's at least possible.
We'll see how it plays out.
Yeah, I am curious. In the next, we'll call it, couple of years, what we'll learn, because I think there's a lot we don't know. At least a lot that I don't know. That's for sure.
Yeah, we'll see what happens. Yeah, a couple other things in here. Oh, here's some of my random notes people can check out. He makes an interesting point, I guess, along the lines of what Brad was talking about there with his change in the companies that make up his portfolio over time. He's sort of steadily transitioned to companies with probably better longer term earnings, but not necessarily great near term earnings because they're investing for growth and so on. But I picked up a couple of things on that. My preference is still to invest in companies that are investing for the long term. However, where that's the case, I would certainly avoid companies with debt so that under all circumstances, as Buffett puts it, they get to play out their hand. And I found this one really interesting. Furthermore, I would insist that losses can be turned off at short notice should they arise. So I guess with Carvana, they were having to spend hand over fist to kind of scale up and build out a lot of infrastructure. A business that kind of came to mind here where they potentially could turn some of these costs off would be like a software as a service business, like a Xero, which is New Zealand and Australian accounting company. A lot of their investment spend, you could argue, is in the form of marketing to try and grow. I forget who at Xero said that, but they kind of said, we can always swim to the side of the pool is the analogy they used with that marketing spend. Much more easily turned off than Carvana spend.
You have the added, I'm not sure if they count this in there, but you have all the depreciating assets in the cars too. So like that's another massive expense you have to worry about in moving inventory and everything. And that's besides all the operational costs like marketing, employees, lots, leases, all that stuff too.
Yeah.
It's a tough business to make fat margins on.
Yeah, for sure. And maybe just to finish up on this, kind of Rob Vinall's final thoughts on Carvana at this stage, in red here. I do not expect Carvana to disappear, though current shareholders may well be heavily diluted. It'll be fascinating to see how the business model plays out in future years. I will, however, bring a higher degree of skepticism to companies that are earlier in their life cycle. So
is he just coffee canning this one? We'll see what happens. Maybe if it goes to zero, well, if it pops, then you get something back. I wonder.
Yeah, not sure. I'd be interested. I'd be interested to see how big a position it actually is now. Maybe it's a rounding error since it's down so much.
I'd be curious because of the double downs.
Well, if they file for a bankruptcy, the stock will go up 2 or 3x like the others we've seen in the last few days.
They get the Hertz bailout.
I think Bed Bath and Beyond, was it?
They're the more recent one.
They went up like 300% after filing a Chapter 11, which is just insane. But
maybe that's what he's counting on here.
Yeah, that's it. He saw the short interest and it was like,
yeah, who knows?
Definitely that. Final lessons from Carvana for now. There will be more to learn later.
I think if you are going to invest in one of these earlier stage companies that are bleeding cash, they they've got to have piles of cash lying around. They can't be funding it with debt. I think that's
I think the debt for growth point is probably, if you had to sum up like one particular issue, it might be that.
Without the cash flow, it's fine if they have the debt for growth as long as they have the cash flow to back it up. At least,
there are other points to it. I mean, I don't mean to say there are not other major points, but that might be like the overarching one, and then directly below that is what you just said, Frank. I agree. That's if you can't service the debt with cash flow, then how do you get out of this?
I like his skepticism towards, I forget his exact quote, but he was saying how the higher the growth rate, the more skeptical you should be, essentially. And I think that's always the case. I think over the past 5 to 10 years, a lot of investors fell into that trap. They moved more towards these really growthy companies because they were doing so well in a low interest rate environment for a range of reasons, I guess. And I think Rob Vinall certainly fell into that a little bit. Maybe this is his wake-up call, I'm not sure, but I've always kind of naturally been that way. The higher the growth rate, the less certain you can be about it. If something is predicted, or even I'm forecasting it grows 50%, my certainty, I guess, is much lower. Maybe I think that's 50% true that it grows that fast. But if something's growing 15%, I'm usually a lot more confident that could be the case. But yeah, I do like that. That's kind of a lesson he took away from it.
Yeah, and I think with some companies, it's easier than others to lay out the kind of practical steps they need to take to grow a certain percentage amount. Like a Chipotle, for example, like you can run through very basic maths on, okay, for them to grow 15%, they need to have some combination of opening new stores and a little bit of same-store sales growth. Whereas other companies, like it's real finger in the wind type stuff to try and come up with a percentage growth number.
Yeah, something with really clear unit economics that you can really just lay out how do they grow and what exactly does that margin profile and everything look like as it happens, which Chipotle is a really good example.
You have this sort of commodity like resource problem here too, in that you're heavily dependent on if you can consider cars like a commodity here, because they kind of are, you're totally at the whims of that market if you're trying to like take up a massive share like this. If car prices fall, that means your inventory price is falling too, even if your margins might have looked good a year ago. So that's like an added thing to try and factor in, which is really hard because you're kind of trying to time the market in some ways in that sense. Whereas with the Chipotle, like we're saying, it's a lot more localized. It's cheap enough that it shouldn't be destroyed by a recession, but you know what I mean? It's just a little bit more resilient and a little bit easier to predict than something based on a commodity. If we count cars as commodities, which sort of works in this model.
Yeah.
I just want to touch on the last lesson, Tom. I don't think we got it. The final lesson is to approach companies with negative cash flows with more caution. Negative cash flow can result from a lack of operational discipline. So, if you're running a business and you don't need to turn a profit, you can get a lot of inefficiencies creeping into the operations. And I think that could be partly what happened here.
Like a complacency.
Yeah, just, you don't have to be efficient.
Because you got shareholders and lenders to take care of it for you.
Right. So that's stuck out.
One last kind of thought, maybe. How much of this has to do with the massive controlling power that the
owner?
That the owners had? I think the only situation in like a major company that comes top of mind is like Meta with Mark Zuckerberg having massive voting shares. How much of that is a major risk factor in general, and then in this case? Because I know we like having owners incentivized alongside shareholders, but in this case, I don't know if they were, because they had so much control.
And they also have a fraudulent background. Not the CEO directly, which was a mistake I made. Same name, the dad, which being involved, like you have to go into that with a high degree of skepticism, no matter what. I know maybe you want to believe the story that he's a changed man, and maybe the son's nothing alike, but obviously the father is still involved. He was a big shareholder as well, I believe. So you have to go into that with a lot of skepticism, I think.
Yeah. Yeah, it's very interesting. I really appreciate investors doing this type of thing. Like Rob this I think it's later in the letter here somewhere, but this is the first major like permanent loss capital Rob Vinall's had since starting the fund. His track record's been really good. Like he talks about some of the other companies that at the time he made the investment, it was like quite controversial, whether it was Chinese big tech or I think Trupanion was a 15 bagger for him when he first was investing in that. People were very skeptical. So yeah, I appreciate the honesty and like kind of putting this out there. He probably has to do it because everyone knows he's in Carvana. He's written about the positives of it a bunch of times, but I like to see it.
And he didn't just complain about the Fed or something, point fingers.
Exactly. Yeah.
You did. You have to appreciate that.
Yeah, the shame, I guess, to it is that it sounds all too similar than a lot of these other fund letters we've seen come out towards the end of, or the start of this year, end of last year, with a lot of these high growth compounder type investors that made the same mistakes as Rob Vinall, which obviously I would like to see him not make. But yeah, at least it is good that he's open about it. But I think it's a very reoccurring theme across the market at the moment.
Yep.
So
at least short,
we should.
That's a recurring theme too.
What's that?
At least he didn't blame the Fed. That's a recurring theme.
Right.
Yeah.
If you, so I guess our final conclusion is that we should back the truck up and go all in on Carvana. Make it the whole punch card portfolio. Is that the conclusion here?
Where's our lawyer?
Yeah. With one minor adjustment, you were right. We should actually be buying calls. I think that's where.
Oh yeah, calls expiring in a month.
Yeah.
Not even a month, in a week.
Tomorrow.
Maximum leverage. Yeah, tomorrow. It's the Saturday or Sunday your time.
So we got a comment from GG Luigi PG. Long time fan. He returneth. How much do you think he was influenced by Cliff Sosin? They are good friends. I've heard them both talk about each other. I don't know. You guys have a take on that?
I'm sure they shared a lot of the research together. They both had the same kind of idea. They both were long the stock and aided on the way down. So yeah, I'm sure they were at least talking about it, and they probably both influenced each other in some way.
Yeah, I think Rob Vinall wrote about Cliff Sosin sharing the idea with him when he first got in. So.
Yeah.
So Rob Vinall can just pass the blame to Cliff Sosin.
There's the finger point. Yeah,
he didn't mention Cliff in the letter. So
the letter just said Cliff Sosin is awful. How dare he suggest this?
Short Cliff Sosin.
Yeah, that'd be rich.
Yeah.
All right.
Overall, I'm still a very large fan of Rob Vinall, but he screwed this one up.
Happened.
Yeah. We will all do something similar in our lives, I'm sure.
Yeah. Many times, I expect.
Multiple times. For starting in our 20s, for sure. Yeah. Shall we move on to Munger wisdom? More wisdom lessons? Or did we want to talk about something else in the meantime?
We can do Munger.
We can do Munger. Can I just check, how old is he? Is he 99 now? Is that
He was
right?
99 on New Year's Day.
That is crazy.
Wow.
Still sharp as ever.
Working.
Yeah, that's really, really crazy.
Yeah. I feel like when people go and see the doctor and ask them, how do I live a longer, healthier life, they should say value investing. Because all these dudes get so old.
No, it's textiles. Yeah. It's a textile company, so that's it.
Textiles.
Yeah.
I saw like a meme video the other day. It was like a 104-year-old woman who was like, I drink like 4 like Diet Pepsis or Diet Cokes a day, similar to our friend Warren. And the doctors told me you need to stop that. And she's like, I've had 3 doctors tell me that, and I outlived all of them. It's just like, let's fit some of that.
God.
How grim. Oh, and after dinner investor just entered. I was waiting for him. He said he doubled his Carvana position this week.
Oh, wow.
Jason needs to finish that story and explain why he did that, because I know the reason, but he's not giving it away here.
And maybe before we move on, Matt has a good question here for kind of all of us.
Oh, yeah. This is actually in Asheville mason jar. So I did not move them from Oakland. Thanks for asking.
So yeah,
Tom,
Matt
your
asked
turn.
if Brad had moved his glass jars from Oakland, and no, they're all gone. And then he asked Tom, does giving away books increase viewership?
How has that worked for you, Tom?
You've done quite a few book giveaways in the past.
I've done a few. I did one. Sorry, Brad, go ahead.
Is that why you did it, Tom, to increase viewership? I didn't know you had that kind of ulterior motive.
Yeah. Well, I've done a few. I did must have been 2019 maybe. I did like a 1-year stock picking competition, which is the dumbest duration for a stock picking competition. But I gave away a few books for that. I actually think a few of them are unclaimed. Like people obviously entered the competition and didn't watch the.
I did one of those too a while back, and it went unclaimed, and I was just waiting for someone to come out of the woodwork to be like, "Hi, can I have the book?" Yeah,
I do remember I had to try and get a copy of the Dundo Investor to like Romania or something once, which was a bit of a process, but we got there in the end. But I think it probably has increased engagement. I think I want to say I gave away a copy of Poor Charlie's Almanac at 30,000 subscribers.
Wow.
And I recently tried to give away a copy of The Education of Value Investor, which is in, well, this is confusing me, in that pile of books that remains unclaimed. Again, there was a winner that I randomly selected from the comments, and again, they haven't come back to claim it. So,
Luis, our man Luis Paz says, I won a book once, and I'm still here. So,
yeah, Luis actually sent me a book once as well. I think I've got a signed copy of Payback Time from Phil Town on the bookshelf back there.
Did Luis sign that, or did Phil sign it?
He told me Phil, but no.
That's nice. Yeah, but like that's cool. Like that you can even have any sort of connection like that. So yeah, that's cool. He asks Frank, where's the beer?
What are you drinking, Frank?
Just water today. I'm cutting back on the beers, I think. I fell into the casual beers trap where it was slowly turning into an every night. And it was only 2, 3. Nothing that I would think, not an alcoholic, maybe, depending on your depth.
Day? That's good.
Not every day. 4 or 5 times a week, 2 or 3 a day. It was getting bad.
Okay.
That's sober in Australia.
That's very common over here. But I'm trying to cut back to just social occasions for my drinking.
Like this. Okay.
Yeah, this could be a good excuse to have one, actually.
Yeah. When you started that story saying I fell, I thought you were about to say like I fell into a drain one night or something. Too many beers.
I fell into a ditch.
Yeah.
Oh man,
Jack, tell us about your business.
It's 1 week in. It's actually been quite smooth. Had like a full week booked out like right away, which is pretty awesome that you can just start cash flowing right away. For added context, now that I can actually share more details, I bought a steam cleaning business, like carpet cleaning and steam cleaning. So think furniture, tile, carpets, that sort of stuff. Go to people's houses, go to businesses, clean it up. We have a couple vans, and you got some technicians in said vans. They drive over there, clean it up. Very simple business model, and it's been around for a few years. Just a couple employees, a couple vans, and something like 6,000 customer emails, and they've served about 800 in the last year. So very active customer base, super great reviews on Google and all the social media sites. So that's the hard part of business, or one of the hardest parts, I would say, is getting that initial traction, getting those first customers, getting those first reviews. In this case, you're cutting in line, get a jogging start. You have to pay for it, of course. And I paid about 180 grand or 172 for this business that does about 300,000 top line and about 70,000 in cash flow each year, with some room to cut some expenses. Like, for example, they had like 2 payment processors when you only need one. So switch down to one. So that's nearly $1,000 a month right there. That's just
Nice.
Just got back. So that's kind of nice. So like some things here and there, but things are pretty well systematized. And the former owner is a real nice guy. I've been working with him pretty much daily, just transferring stuff over, asking questions as stuff comes up. It's nice having actual business to like have examples to work on and be like, hey, this thing, is this normal, or what do we do here? And what have you guys done before? And it's been really good. And he's been a nice guy. And I've enjoyed kind of working with him on this transition. So yeah, that it's gone really well. Just hired a general manager as well. I interviewed a bunch of people over the last month. Officially hired someone. They'll be starting on Wednesday of this next week. So basically, I'm gonna be kind of finishing my transition, and then I'm immediately gonna be transitioning someone else, and then we're gonna learn together, of course, because I'm new to the steam cleaning business. Thankfully, there doesn't seem like there's too much to learn, but there's plenty to learn. And yeah, so that's kind of the next step. I'm pretty hyped. It's a lot of fun. Like there's challenges and there's some stress, but I really enjoy it. It's cool having something like you can build and work on that's doing stuff like right now. It's pretty cool to just kind of get plugged into that and now start steering the ship. So I've enjoyed that.
Awesome, Jack.
Thank you, Brad. I appreciate it. We talked about it a good
too.
amount when we met a few weeks back. So yeah, and thank you for the congrats in the chat, everyone. I appreciate it. So yeah, that's what's going on there. And I'll be dropping some more updates as we move along. Probably do like a live stream or something tomorrow, potentially. No, don't quote me there, but I do want to start doing some like business live streams, just talking about strategy and stuff like that, and problems I'm facing and things I'm thinking about. I think it'd be interesting and
Totally. The nitty gritty.
yeah, and be a good way for me to think through ideas too. So good excuse.
You could sit on the live stream just going entrepreneur.
Yeah, in control, completely in control the whole time.
So anyone
Yeah.
in Houston, if you need a steam clean, reach out to Jack.
Yeah, you know where to reach me. I don't want to share the phone number publicly on this stream because very few people are in Houston, and no need for spam. But yeah, it's pretty fun. And the hardest part is not getting carried away and like jumping into another deal right now. I want to like make sure this is really done right, stabilized, and get it growing first before I start even potentially looking at another deal or anything like that. But I think I have a feeling by the end of this year, I'll probably have another deal under my belt if I had to guess. But want to get this one right first, of course, and do some deleveraging, like I mentioned towards the top of the show. So yeah, that's that.
Nice.
So-
You'll clear a lot of that debt pretty quick.
Yeah, off to a good start. So pretty much all of my salary, and then most of the business cash flow I'm just saving for now. Had quite a few outflows for this first week, getting new insurance policies and all that rolled over. So you have to pay for that. It's a few thousand right there for each of those, and but that won't happen next month. And then I will say for the manager, what we're doing with that is I'm going to give the manager a revenue split. So they're just getting a cut of the top line revenue, and that way they're incentivized like an owner, but I don't have to give them equity. So I think the ideal one of my thinking was when I was hiring for this position was I want someone who probably has built stuff before, but ideally has actually owned their own business before, but doesn't really want to go into that and start putting out their own money and everything and risking it themselves. Someone who likes the game of building, but doesn't necessarily want to have that same kind of risk. So And I found quite a few candidates like that who maybe owned businesses 5 years ago, sold, and maybe want to get back into it and like the opportunity. And the only hard part is the best candidates all have jobs. So for something like this, so trying to pull some people away too. That's how I'm going to be doing that. That way they're fully incentivized to grow the business. And yeah, maybe at some point we'll give up some equity, but not off the bat.
Why revenue split? Why not?
You could do profits. It gets a little, I just wanted to be a very simple calculation. So I can share, let's just say it comes out to almost half of profits based on the margins of the business. So that's how I'm doing it. So it's like they're getting about half of profits, and it should be that way the whole way because margins are something like double the revenue split I'm giving them, which is around, I'll give a range of 20 to 30% margins. So they're basically getting half of that, just about, on the revenue split. So yeah. And I've talked to some other people who do similar things like that, give a revenue split for key employees. And it seemed like it made sense for this role, given the cash flows are pretty stable off the bat, but they're not super high, like relative to like what a big time exec would make. But I wanted to give them some serious incentive to grow. And it's going to be kind of my job to focus on profitability. It's their job focusing more on growth. But if profitability gets out of whack, I'll be like, hey, we got to fix that first before we keep growing. So yeah, and I'm still going to be staying very up to date with it. And I'm still going to be working on this business, but now I'm going to have someone totally full-time to focus on growing it themselves too. So kind of leverage the growth that way. And if it's a disaster, I'll have to move on, but hopefully it's not.
Nice.
What is this? I see this. Yeah. Matt says, smart move. Well, thank you. We'll see how smart it is. Eventually offload it to a partial owner so you can focus on your specialty capital allocation. Yeah, that would be ideal. It's, I think long term, if this is a great manager and we grow the business in a significant way, probably would make sense to bring them on as an actual shareholder, give them like a stock-based compensation, that dirty word, and allow them to take partial ownership so they're really actually aligned. And but that's pretty long term from here. I wouldn't want to do that yet. So yeah,
good stuff.
Big moves.
Frank, I know you're interested. You're saying you were doing some work.
You're inspiring, Frank.
I'm really interested. I kind of have always liked the idea of buying a small private business, but you've really motivated me to really actually start looking. It was mostly just a idea in the back of my mind, but I'm getting a little bit deeper into the research. I've pulled a few financials from 2 different companies, one being a cleaning business. I want something along the same lines of something you don't have to have a background in to be able to understand fairly quickly. I'm not going to go and buy something super complex and try and operate a business I don't have a deep understanding of. But it's still very early stages. It's not something I would rush into. I'd probably spend a long time looking before I actually really considered. So, and I'd also have to get the approval of the old fiance. So that would be another challenge.
I do have a distinct advantage of not having kids yet, so now's the time to take some shots. But yeah, that's cool, and that's the first step, just getting the financials and taking a look. And obviously, we're all pretty comfortable with that from our public stock adventures. So in that way, it's not that far off. It becomes more of an issue of strategy and actually doing the capital allocation ourselves rather than expecting some CEO to do it for us, like with a public stock. But that's the fun part. That's how you get better.
Frank's beard oil. You could use your Twitter profile picture and everything, I reckon, as the logo.
The dripping
the YouTube
one?
channel's back up and running, so I can start selling some merch on there.
Nice.
the Frank Tabor channel's back up, which is super excellent.
Yes.
So it's
Good to be back.
great. Welcome back. In hibernation for all those, was it about a year, right?
Yeah, I think 9 or 10 months since my last video was posted.
Man, I was back at
I've
it.
got
How have the
two
first two
back up.
videos performed? I know you did the Bury and Icon kind of documentary bios.
Yeah.
They're well put
So
together.
the first one, I think, as I left YouTube, I was getting about 2,000 views on average. The first one I put back, Bury, has done about 1.8 thousand, so pretty much straight back to where I was.
Right.
But this Icon one's a little bit lower off the get-go, so I don't think it'll end up much over 1,000. But the subscribers have jumped again pretty quick. I've got a bigger Twitter audience now, which helps as well. So it'll be interesting to start to get that YouTube algorithm momentum happening again.
And I think you have, with that type of content, it's a lot more evergreen than, what is Alibaba stock doing this month, So
yeah,
I assume that'll give you a long-term edge, which is great as long as you keep it up. So glad to have you back.
I guess for those that don't know, originally I stopped for regulatory concerns here in Australia, where I couldn't really talk stock specifics too much, or I had to really be careful with how I was talking about things, which obviously I was doing before that regulatory kind of change or focus. I was doing a lot of that online, which is why I've really shifted the focus now towards a more history of investing and the best investors and capital allocators and what made them successful, rather than stock coverage and news, I guess, which is different than the audience. Like, I have 6,000 subscribers. Probably a large chunk of them are more interested in stock updates and things like that. So I will be kind of rebuilding towards a different audience, but it's definitely much more enjoyable, I think. Not too different. I'm sure there's a lot of crossover, but
yeah. Because if you're talking about, like, a lot of our content is investor wisdom and lessons and stuff. So yeah, I don't think you'll have a lot of what's it called, attrition there. But either way, best of luck and glad to have you back in full force on YouTube.
Thank you.
All right, shall we get into some Charlie Munger to close it out?
Yeah, we can dip our toes in that. Where should we start?
Yeah, Karan kind of suggested we talk about some of this, and of course he's not here. He's gearing up for a wedding, guys, in about a month from now. So we might be seeing limited Karan in the next few weeks. So, but it's for a good reason, right? It's going to be a big old wedding in Dubai. So Brad, do you want to kick us off with one? Sounds like you have a lesson.
I don't. Maybe we can pull up a list or something.
That was a heavy sigh. Like
a cherry pick.
I'm happy to touch on one pretty quickly if you want to.
Okay.
Just
Yeah, go ahead.
Quick and easy, and more so just 2 book recommendations to kind of get out of it as well for anyone interested. So the original Charlie talk, I think, was called, let me get it right, The Pursuit of Worldly Wisdom. And he's kind of done a couple of variations from that. Tom, I think he said there's 1 or 2 versions in the Poor Charlie's Almanac, which I'm yet to read, but a lot of them you can find online anyway. And it's kind of covering a theme you probably hear Charlie talking about a lot, which is that kind of lattice work framework, or the multi-disciplinary approach to thinking or learning. So there's a book by, I think it's Trent Griffin. It's called Charlie Munger, The Complete Investor. And I'm actually yet to read that. That's the next on my list. And I've read kind of some summaries and key points online, and it sounds like a really great book covering kind of this exact topic, or just Charlie Munger and his thinking in general, that kind of psychology side. And I guess the real idea around it is Charlie talks about having a great understanding of all these different fields. He quotes psychology a lot, biology, all the different science, mathematics, and then applying them into your chosen field. Investing being the case for, I guess, where he's usually kind of directing that audience, I guess. And the other book I wanted to say is The Art of Learning by Josh Waitzkin, which is maybe my top 3 favorite books, at least, maybe number 1. I really enjoyed the book. He's like a chess prodigy that turned into a Brazilian Jiu-Jitsu black belt, which being two of my favorite things, chess and jiu-jitsu, the book is right up my alley. But regardless of your interests, it's a great book that you can take a lot of lessons away.
The Art of Learning by
The Art of Learning by Josh Waitzkin is his name.
I just added it to my list.
He's super smart guy, really young chess prodigy, world champion, all of that stuff at a really young age. So he had this really deep understanding of chess, and was really pushed into it by his father and stuff too. He was also pretty high level, I think, grandmaster as well. And then he kind of took that skill set and applied it to Brazilian Jiu-Jitsu. So the whole idea that he's kind of pushing is to have these underlying principles or a conceptual framework around something and taking all of that and applying it to everything else. So all of the things, the strategy and things that made him a great chess player, he then applied to Brazilian Jiu-Jitsu and really excelled and got a black belt way quicker than the average person. Maybe in like 1/3 of the time frame of the typical black belt, without necessarily more training, but from his at least explanation was
his frameworks and
his framework and way of thinking. So in kind of anything, I guess Brazilian Jiu-Jitsu, a lot of people go straight to these techniques and they want to apply a technique, but without the underlying concept or principle behind it, you don't know why or when you should be applying that technique. In chess, it's exactly the same thing. And then I think you can apply that in investing, almost anything else in life, that there really has to be these principles that oversee everything.
That Tom, I know you've read Range, but that by David Epstein. Is that right?
Yeah.
There's a lot. It seems like there's a lot of. It's definitely not the same concept, but it's very similar. Kind of having multiple perspectives and skill sets in very different areas can create unique sort of perspectives in other areas. You might want to read that one too, Frank, if you haven't already.
Yeah, for sure.
Yeah, it's a well-written book too. A lot of cool like stories and case studies about like great athletes, scientists, musicians, and who came from very different backgrounds. And it actually talks about chess in the opening chapter and how it's a little bit different because it's a finite set of rules technically, whereas compared to more dynamic things like particular sports or whatever it is. But without spoiling the book, it's a good one about kind of similar sorts of topics.
The movie Searching for Bobby Fischer is based on Josh. If I recall, I think how Josh learned how to play chess, most people start with opening moves, right? But Josh he'd have like a king and a pawn against somebody else's king and kind of build out from there. Mm-hmm. So it's very different from how most people think about starting.
I'm just getting into chess. Frank and I have discussed because Frank's actually quite good at chess.
I'm not really. I'm slightly better than you.
By amateur standards. Definitely better than me, but by amateur standards, quite good. For the average person, well above average. For the average chess player, maybe not.
I love that compliment. By amateur standards, you're quite good.
Yes, exactly. Yeah, because
chess is one of those weird things that I really like because the average person really has. It's kind of similar to investing, actually. They really have no understanding of it whatsoever. So if you kind of learn these core fundamental things, and Brazilian Jiu-Jitsu comes in this as well, you can really quickly be way better than someone that doesn't play regularly. And it's kind of an endless learning curve. The crossover between these three things that I really am interested in, investing, jiu-jitsu, and chess, is there's no end point. You can kind of learn forever. There's always more to do.
I mean, yeah, you got the armbar locked, so you got to work on some other things at this point. So yeah, I think you could probably say that about anything. It's like the first however many hours you spend into it, you're already well ahead of 99% of people. It doesn't mean you're the best in the world, but you're better than all the people who haven't touched it ever, just with a little bit of effort. Yeah, I don't think that's unique to any one thing. I think that's just about any skill or any thing you study. Yeah, it's a good perspective, though. I should say it puts it into perspective a bit more.
Yeah, I think about that with investing, and it's like, well, if you put, a couple of weeks into it, you're probably still not going to beat the market, right? So it's kind of interesting to think about.
There is the, a little bit, just enough to be dangerous. Whatever that breaking point is where you're no longer super dangerous to yourself, maybe. But But like
you could probably learn to super low cost index for the rest of your
right,
life.
yeah, like that was
Yeah.
my first kind of lesson when I was reading stuff. I learned about like buy real estate and hold it, and index fund investing. Like I was like, oh, that's easy to understand. And if you do that and nothing else compared to someone who does nothing or
It's
just
amazing
randomly
how
roll into
many
stocks,
the
like you're
average
going to be
person has no idea about that. Like if you ask
Right.
9 out of 10 people on the street, they probably don't know what index investing or dollar cost
exactly,
averaging.
exactly.
Something that anyone could do. Yeah, it's very unknown, unfamiliar.
Yeah. But even just like a little effort can get you somewhere.
Mhm.
At least when you, it's hard to get worse than nothing. Like you really got to be led down a bad path to be worse than just knowing nothing. Someone gives you misinformation, wrong information, that can be damaging, but that's, I think that's pretty rare.
Just don't learn how to invest from TikTok, right?
Yeah, right, exactly. That could turn you off of investing entirely.
Unless it's Jack
many years.
Duffley's TikTok, then
Right.
Yes, my very, I don't want to say milk toast, but very positive, not hype TikToks. Just me talking.
Fireside chat with Jack Duffley.
Oh gosh, I forgot about those. Those are good. Those are a lot of effort for not a lot of reward. But those were fun. I only did a couple of those. I don't have the cool basement set up anymore. There's no basements in Houston. Too much flooding. Oh, should we actually get into some Charlie Munger wisdom now? We talked about books off the bat.
I touched on it, but I moved away more towards Josh Waiskin. And the actual theory is kind of different. I think Munger's more saying understand a lot of different topics well, then apply it into one. Whereas Josh Waiskin says understand one thing really well and then apply that into everything else. So it's kind of the inverse of what Munger suggests, but both are very reasonable things to do. I work in education as a teacher, so that's kind of two approaches you do use in teaching, or at least learn about in uni and hope to apply within teaching as well. So it is a great way to learn for anyone. So
yeah, it's yeah, you definitely should read Range then, because Range is more of the Munger kind of broad perspectives and then late specialization. Yeah. Anyway,
it's kind of a response to like the 10,000 hour rule.
Right. Exactly.
Specialize in something for a really long time. Sort of tells stories of, generalists or engineers that randomly come in and solve some scientific problem that super specialized people have been working on for a long time. Yeah.
My favorite one is the Vivaldi story, and these like savant musicians that like carried him. Like I didn't really know about that. It was interesting. There's a lot of interesting stories in there.
What kind of currency is that?
GG Luigi PG, 1,000 yen.
Wow.
I don't know what that converts to.
if you have a question, GG Luigi PG, feel free.
Hit us up.
Feel free to drop it.
What was that name, Frank?
I don't know.
Don't make him say it again.
Say that 10 times fast.
GG Luigi PG.
All right, so I guess that's our Munger wisdom.
I've got a few.
Okay,
Yeah, Tom's got some.
Yeah,
He's got the book right behind him. Look at that.
Yeah, I broke open the Poor Charlie's Almanac and did a bit of a refresher before this. But like the back half maybe of Poor Charlie's Almanac is just Munger speeches. And there's one that I really like where he talks about inversion. We've heard there's like the famous Munger quote all over the place that's invert, always invert, which if you actually read the speech from Charlie Munger, it's actually from a mathematician, Carl Jacobi. He's the one that said that, and Munger's just borrowing that idea. So Munger has said it, but that's where that came from. So basically Munger did this speech there was the Harvard School commencement speech in 1986, and the way he approached that speech was to look back at we should pause for the super chat, I think, actually, before I go any further.
Thank you.
All right. Toonie says, pleasure to hear you chaps live today. Thank you. Pleasure to have you here. I normally listen as a podcast during the week. Keep up the good work. If you have a question, please let us know, Toonie. We appreciate it. You were saying,
do
Tom.
people know that we have a podcast version of this? That wasn't a thing for quite a long time.
Yep. We get a good at least 50 people just doing the podcast downloads like within the first week. I don't know what it is after that, but we do have a podcast version if you prefer that. Granted, you won't see any graphics or anything we show on the screen, which we do sometimes. We try to explain it as much as we can within reason. But we do have a podcast version. I think it's linked below. But if you just search Punch Card Investing Podcast, you'll find it. It's on all the major platforms, or just about. Certainly on Spotify, so you can go there to start.
Yeah, cool.
Keep going down.
So yeah, the speech that Charlie Munger did, basically his approach to it was to actually look back at 20 previous Harvard commencement speeches and pick which one he liked the most, and then expand on it. So he found a speech from Johnny Carson, who I actually must admit I'd never heard of, but he's a like late night TV show host, I think, from the States from back in the day.
Yep.
And Johnny Carson basically did this speech. He kind of went into it with the idea of saying, I don't really know how to tell you how to live a happy life, but I can give you a few tips on how to lead a miserable life, and maybe we just work backwards from there. And he gave them 3 points. So he said, in order to guarantee misery, you want to do these 3 things: ingest chemicals in an effort to alter mood or perception, envy, and resentment. Those were kind of the 3 things that Johnny Carson had. And then so Charlie Munger kind of took that speech and ran with it and added a few extras. He liked those initial 3, but he wanted to add another 4. So his 4 to guarantee misery were to 1, be unreliable, 2, learn only from your own experience and not from others, dead or alive, go down and stay down, and ignore I wish I knew where I was going to die and then I'll never go there as a mere quirk with no underlying wisdom. So there you go. Thoughts?
Does Charlie Munger, does he drink?
I'm pretty sure he doesn't.
Yeah, probably not. I don't know.
Coke, yeah. Just Coke.
Yeah, besides that. Chemicals, like you're saying.
Yeah.
I think, where was it? It might have been in Port Charlie's Almanac. No, it was a talk he gave. He said something like, he got this advice from his dad. Why would I spend money to put something in my body that makes my head work less well?
Right. I feel that. We're just talking about this, Frank. I'm glad you're off your 3 beers a day. We need your head working well, Frank.
Some things make your head work more well.
Certain types of beer.
Yeah. Certain types
moderation.
Yeah,
moderation.
Fine white powder in moderation. Matthew McConaughey style from Wolf of Wall Street. Keeps it sharp between the ears.
There's some good comments here too about Charlie wisdom. I like Matt has one. You pull this one up, Jack, at 10:12 or 9:12. The fishing tackle manufacturer had all these flashy green and purple lures. I asked, do fish actually take these? Charlie said, I don't sell these lures to fish.
Yeah.
I love that.
I've been a victim of that, I must say. Yeah. But I do enjoy Charlie's life advice here, but I also think that you can apply a lot of the inversion principles to investing as well. I think
it's a super versatile concept. Yeah, you're saying.
Yeah, I think I may redo like another version of this soon, but I don't know, 2 years ago or something, I did a video on the channel about I think I called it something like how to be a terrible investor, which was
I think I remember
inspired,
that.
Yeah, which was inspired by the speech of just kind of inverting the whole problem. And I forget exactly what I came up with, but it was things like, make sure you always react in react to stock prices. Those should be what drive your investment decisions. Like
Right.
the extremely emotional.
The technical analysts are freaking out right now.
Yeah. I don't know what else we could add there. Like buy the most expensive stocks you can possibly find. It's a nice way to go about solving problems.
Yeah.
Alex Hormozy, the kind of business content guy, he's a big Charlie Munger fan too, and he uses the inversion strategy a lot for like, what would you do to not sell things, or what would you do to run a business poorly, that sort of thing. And it's just a super useful framework for so many things, because for whatever reason we're very quick to shoot things down as humans. So it seems like it's easier to come up with reasons why not to do something than to do something. So you're almost using that predisposition to your own advantage.
How would you kill your steam cleaning business, Jack?
Oh gosh. Let's see here. One, I'd stop all outreach, like all paid or not paid marketing. That wouldn't help. Wouldn't show up on time. Would not hold my employees accountable. Would try to do everything myself. And I could keep going, but those are some big ones that come to the top.
Never maintain your trucks or your equipment.
Yeah, not maintaining equipment. I guess we could say like leveraging to the hilt beyond what I'm already leveraged at. But
I learned that one today.
Yeah. Those are some good ones. There are more for sure, but certainly if you could not do all of those things, you'll be in pretty good shape. Don't respond quickly. Don't respond at all. Don't respond at all to inquiries. Insult your customers. Don't listen to your customers. Don't respect your customers. Don't respect your own work. Yeah, you keep going. Lots of bad things.
Tom, Eunice wants to short the worst investment idea. We need to have a little chat with him.
Yeah. Thou shalt not short.
Thou shalt not short.
That wasn't Munger, but.
Alrighty. I think that's a good spot to wrap up. Inversion, always that's an old reliable right there. And my favorite Munger quote is, show me the incentive and I'll show you the outcome. It's my favorite. Old reliable.
Beautiful.
He's got a lot of reliable ones, but this got to be my favorite. It's just we're talking incentives with the employees too, right? Like that's what I'm thinking. You incentivize someone to want to grow the business, you're much more likely to get to that outcome than if you didn't incentivize them. Nothing's guaranteed, of course. Anywho, thanks everyone for tuning in. Check out all the great stuff in the description below. Discord link, the discount links to Seeking Alpha and to ShareSite. Go check those out. Get a discount on a premium subscription for both of those, or you can sign up for the free versions as well. That's all well and good. Like, comment, subscribe, and till next time, everyone. See ya.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.